Last video we talked about market regime, bullish, bearish, or neutral, as an observable state of the tape. And we said that state is readable from public data. The follow-up, what public data specifically does ArcAlpha aggregate to produce that read? 6 sub-indicators, all derived from public ETF flows and cross-asset price action, composited into a single score between 0 and 100. Higher means more risk on, lower means more risk off. This video walks through the 6, what each one reads, why the platform uses the specific ETF proxies it does, and how they combine into the one score that sits at the top of the markets page. At the top of the markets page is the risk gauge, one composite score, one label, a single glance read on whether the tape is risk on, risk off, or somewhere in between. The score runs from 0 to 100. Higher numbers mean risk appetite is up, money is flowing into growth, protection is being sold, cross assets are aligned bullish. Lower numbers mean the reverse. 3 labels sit on the score. Risk on when the composite is clearly high, risk off when it's clearly low, neutral when it's in the middle band, no strong bias either way. The value of one number is that you don't have to read 6 separate charts every morning to know what kind of day it is. The platform does the reading. You see the conclusion. But a single score can hide what's driving it, which is why the gauge expands. Below the composite, you see each of the 6 sub-indicators with its own reading. Let's walk through them. First pair both read where money is flowing within equities. First, leveraged flow. Which side of the trade is more aggressive money chasing, the bull leverage side or the bear leverage side? The platform watches volume across leveraged ETFs. Whichever side dominates tells you where active traders are leaning today. Real money being committed, not survey data. Second, sector rotation, which we covered last video. Growth sectors, tech, consumer discretionary, communication services versus defensives like utilities, staples, healthcare. Growth leading means risk on, defensives leading means risk off. Together, within equities is capital leaning into risk or away from it. Second pair both read how much is being spent on hedges. First, VIX regime. Volatility ETFs move against each other depending on whether the market is paying up for protection or selling it. The reading gets one of 4 labels: calm, normal, elevated, or fear. Calm and normal are bullish for equities, elevated and fear are bearish. Second, buffer positioning. Buffer ETFs are funds that cap upside in exchange for downside protection. Institutions use them when they want to stay in the market but limit risk. When money flows into the more protective variants, institutions are hedging. When it flows into the less protective variants, appetite for pure upside is back. Together, is the tape paying up for protection or selling it? Third pair, what markets outside equities are saying. First, bond regime. Bonds and equities usually trade in opposing rhythms. When money is flowing out of bonds into risk, that's typically bullish for stocks. When there's a safety bid into bonds, that's typically bearish for stocks. Second, dollar strength. A weakening dollar tends to be bullish for equities and commodities. A strengthening dollar pressures both. Together, are bonds and the dollar confirming the equity read or disagreeing with it? Cross-asset agreement is the cleanest signal. So 6 sub-indicators, each reading one axis of risk appetite. The composite averages them, weighted so each one contributes equally. The output is the single 0 to 100 score at the top of the page. On the markets page, you see the composite first. Below it, the 6 sub-indicators with their individual reads, so you can tell at a glance which ones are driving the overall label and which ones are diverging from the rest. Divergence across sub-indicators is useful information. If leveraged flow and sector rotation are both bullish but VIX regime is firmly elevated, the tape is mixed. The platform labels the composite neutral, and a trader reading the breakdown knows why. The platform aggregates 6 public reads into one score. You decide whether the current label means more weight on your chart, less weight, or about the same. So that's the frame. One score built from 6 sub-indicators: leveraged flow, sector rotation, VIX regime, buffer positioning, bond regime, dollar strength. A composite read on risk appetite that updates as the market does. The risk gauge isn't a timing tool, it's a context tool. It changes how much weight you put on the individual setup, it doesn't tell you whether to take one. Next video, the last piece of the market intelligence picture. Not indicators, the calendar. Which scheduled events reliably move markets more than others, and why knowing the calendar matters as much as knowing the risk gauge. This is educational content, and is not a recommendation to buy or sell any security.